All right, so welcome to Learning Objective 2 in Chapter 1. This objective introduces you to what they consider to be three principal types of activities that business does. These are financial activities specifically. And so we're going to learn about these today, and you'll have some reading and homework to do on them. The first type of activity they introduce you is something called a financing activity. Now, believe it or not, you're probably well aware of what a financing activity is, maybe without even knowing it. So, a financing activity is answers the question, how are you going to get the money to pay for this? So, you go into a car dealer and you want to buy a car, it's $20,000 car. Okay, well, financing. How are you going to finance that $20,000 car? In other words, how are you going to get the $20,000 to buy the car? Um, and so people usually do a couple of things, right? Some people actually have the money to buy the car outright. Amen, hallelujah for them. Some people need to borrow all that money, and some people have some money that they can put in, and they borrow the rest. So financing activities really revolve around where, for a business perspective, where businesses get money to buy things that they need to purchase. Okay, so we'll talk about that on the next slide. Then after, they're going to introduce you to something called an investing activity. So I need you to take yourself out of a personal perspective here, because every time I talk about investing, people automatically think personal investments. I need stocks, bonds, mutual funds. Okay. We're going to look at things from a corporate perspective and a business perspective. So an investing activity for a business is really purchasing something that's going to help them generate more revenue, help them generate more sales of what they sell. So, for example, if I owned a pizzeria, um, and I hope I don't make anybody hungry with this story here, but if I had a little pizzeria shop here and I wanted to do an investing activity, there's a few things I can do. Number one, I could probably update my ovens, right? So one of the things I can do is, if I have more efficient ovens, I can actually bake all my pizzas and subs quicker, and thus I could sell more pizza. I could sell more sub. So, that would be an investing activity. I could also buy a delivery truck, because some people might love my pizza and sandwiches, but they want it delivered. And so, if I had a delivery truck, I could actually load it up with a bunch of food and have it been delivered, and that generates more uh, sales for my store, because I can sell more stuff because of that. Or of course, I could expand my store, or open up another building where it's a lot bigger, so I can fit more people in to enjoy a meal, at my pizzeria. Thus, those are all examples of investing activities. What they all have in common is, this is a business that's interested in purchasing resources, which we call assets, that you're going to learn about, that the business uses to really make more money. Every business has to sell something. And so the purpose of businesses having all these resources or assets is to help them sell stuff. An investing activity increases that potential. Now, it is also true from a personal financial perspective that you can purchase shares of stock in a company, and that's an investing activity. Yes, that's true. It's also true for corporations that if they have a lot of cash and they want to make those types of investments, they can. So that can also be an investing activity. It's just not the best way to use their money. The last thing you're going to be looking at and introduced to is something called an operating activity. And an operating activity only happens when the business is operating. Now, what does that mean? It's open for business. Operating is it's open for business. And so some businesses have very specific operating hours. They might open at 8 o'clock in the morning and close at 10 o'clock at night. So when they're open for business, that's their operating hours. And anything that's happening is an operating activity within the operating hours. Of course, today, many businesses are operating 24 hours a day, 7 days a week. So operating activities can happen during any of those times. Okay, whatever. So you're going to be learning a little bit more about all of that. And of course, accounting basically helps us keep track of all these activities and make sense of it all, as you'll get to know in the next objective. So let's take one at a time. The first thing in more detail of financing activity, like I was mentioning, where does the business get money to purchase things? So let's say the business does want to buy or build another building. Say they're expanding, they want to build other buildings. Where do they get the money to build the buildings? Right. So do they have it themselves? That means the owners are putting it in. And so if the owners are putting the money in to the company, that's what equity is about. The owners of a corporation are called shareholders or stockholders. And so that's why we talk about stockholders' equity for the ownership in a corporation. In a small business, sole proprietorship, partnership, it's simply called owner's equity. But this book focuses on the corporation. So stockholders' equity. That's the owners putting the cash into the business. What do they get in exchange? They get shares of ownership. Shares of ownership and common stock is the same. So shares and stock, these are interchangeable words. The word shares and the word stock mean the exact same thing. Okay. And what that means is the owners are putting cash in to the company and they're getting ownership for that cash. What are they hoping is the company uses that cash to buy stuff, to sell more stuff, to be profitable. So one way businesses get money is from their owners. Another way businesses get money is to borrow it. Okay. Borrowing money is a debt, and all these debts are called liabilities. So this is a specific word in accounting that you're going to hear all the time, liabilities. But liabilities, generally speaking, is if you owe it to someone else, it's a liability. Okay. The more common liabilities are debts. Okay. And so a bank could give you a loan or an investor could give you a loan. Those are debts that have to be paid back. Anyone who lends you money is called a creditor. Some people look at it as a lender, but lenders are creditors. Anyone who loans you money is a creditor. And there's a couple of different common types of liabilities that you'll see over and over again. One is something called a note. Notes in accounting, the word notes is basically is a loan. They tend to be short-term loans, something that's due within a few months or within a year or so. So a note payable is simply a short-term loan. Okay. And those can come from any type of creditor. Then a long-term loan from investors is what a bond is. Everyone knows about the stock market because they talk about it all the time. But the bond market is equally important. The bond market is where investors go to lend money. Okay, because investors lend money as well. It's not all about ownership. You can also be a lender. And so when corporations borrow money from lenders, that is called a bond. Okay. So a bonds payable is simply a company that has borrowed money from investors that owe that back. It's a liability because it's debt. It's got to be paid back. It could be paid back with interest. So financing activities really kind of revolve around two things: the debt of a company, how much they're borrowing to buy stuff, and the equity in the company, how much the owners have put in so the company can use to buy stuff. So those are the two main points and main sources of financing activities that you need to read about. An investing activity, the second type of activity, again, as I mentioned, we have to really kind of take ourselves away from the personal financial issues of investing. When we always think about investing from a personal perspective, where we're buying stocks, bonds, mutual funds, things like this. The most important investing activities that companies do is really they purchase resources that they use to sell more stuff. So, like my little pizzeria, more efficient ovens means more pizzas can be cooked, which means I can sell more pizza, which means more profit for me. If I had that delivery truck, right, that means I can also sell more pizza because now I can deliver more pizza because I have a means to do so. These resources help me operate and become more profitable. So these resources, such as, computer equipment, delivery trucks, more furniture and fixtures, new buildings, etc., are very important. In accounting, we call these assets. That's a very important term that you need to know. So assets are resources that are owned by a business. The main purpose of these resources is to help the business sell whatever it's selling. Okay, very, very important to know that. That's an investing activity. Yes, businesses can sometimes have a lot of cash. Large corporations today have billions of dollars in cash on their books, like Apple, like Microsoft. They have billions of dollars of cash. So having all that cash might not necessarily be worthwhile. So they might go ahead and actually purchase investments temporarily for that cash to be held. So in that sense, that is also an investing activity, but it's not the primary one. The primary investing activity that we focus on in business is buying assets that help us sell more of our stuff. The last activity is something that, again, happens when the business is open and operating. So you imagine if your business opens at, say, 8 o'clock in the morning and goes all the way through 10 or 11 o'clock at night. What's happening during those business operations? Well, customers are coming in and buying stuff, right? So one of the most important operating activities is for you to sell whatever you're selling. Revenue is a very important term to understand, because revenue is basically the amounts that you've earned by selling your products to customers or selling them the services. Remember, there's two different things companies can sell. You either are selling a product or a good. So that's a physical good. You walk into Walmart, all they do is sell products. Or you can deal with companies that sell services. And a service basically is you're paying someone to do some type of work for you, whether that's legal work, accounting work, keeping your books for you, getting a haircut, having your house painted, things along that line. These are all, this is revenue from services, And so basically speaking, everything starts with revenue. Nothing is more important in accounting and finance. And I'm a financial person. I'm MBA finance. I'm not a CPA. I can tell you that everything revolves around revenue. You have to make money, okay, by selling stuff. A lot of students will, when I have them for general business classes, they'll say, I'm interested in starting a business. And the very first question I always have is what you got to sell, right? Because everything is what you sell, what you earn from what you sell is your revenue, and everything starts here. Revenue is also very critical for not just for-profit businesses, but also for nonprofit organizations. All nonprofit organizations need revenue to exist. So whether you're the Boys and Girls Club, well, you got memberships to sell, right? The college itself is a nonprofit. What we have to have something for sale. We have, courses, we have certificates, we have degrees. These are the things that we sell. Every organization needs to have something that it sells. In other words, it needs to have a source of revenue. So when a company sells products, that's what sales revenue is. The word sale is associated with a physical product. So Walmart has sales revenue. Okay. Service revenue is revenue generated by providing a service. So again, you might go into a doctor's office or a lawyer's office, or visit an accountant, or have your hair cut for that matter. They're providing a service. So that's service revenue. They're making money by doing work on your behalf. Right? And even if you make money from a loan, which banks do for a living, and all creditors do for a living, they make loans and they get that money back with interest. That interest on the loan is their revenue. Is their revenue. So revenues are critical to all different businesses, and it's important to understand what how your company generates revenue. What does it have to sell? And if you're looking to start your own business, that's a key question. What are you going to sell? Another thing that happens when the store is open is inventory is being moved, being stocked, being taken care of. So inventory is what we call the products that are on the shelves at a store. Now, before you and I can walk into our local retailer, I'll pick on Target now. You walk into a Target and you look around, there's a whole bunch of goods. Well, they had to buy those first and put them in the store. So retailers like Target, Walmart, all the retailers, they have to have inventory. Okay. They have to buy goods and put them in the store, and then they sell them to the customer. So before the customer can come in, they have to have this stuff. So this is important, and a very important term to know what inventory is, okay, because you'll see it quite a bit. Another account that you're learning about, and you will learn more about, is something called an accounts receivable. Now, most of the time when you and I walk into a store, whether we're paying with cash or a debit or a credit card to a company, that's a cash sale, because cash is cash. Debit card simply moves the cash out of your checking account to them. And a credit card, basically the bank that you have your credit card with, gives the cash to the merchant and gives you a bill. How nice, right? So when you and I walk into a store, we're never going to need to worry about an accounts receivable. But businesses do business with other businesses. So business to business sales are quite important. And sometimes one business will let another business purchase something from them and give them an invoice. And that invoice says, you have to pay me for this in the next 30 days. That's basically what an accounts receivable is. You've already made a sale, you've already sold something to the customer, but you're waiting to receive money from that customer. And again, it won't happen to you and me as individuals, but it's very common for business to business transactions. Of course, if you have revenues, which is selling your stuff to customers, you're going to have expenses. They go together. So expenses are really all about making sure you are recording all the costs involved in helping you sell your goods or services. Okay. So expenses are extremely important. You're going to be getting a whole list of specific expenses um, that you'll be learning about in this class. And basically just understand that if you have something to sell, you're going to have expenses in order to sell it. So even for a doctor's office to function, right, they have to pay, they don't own the building, they have to pay rent. They're renting a suite. They have to pay other types of things to make sure the office is running properly. All those would be expenses. All those would be expenses. So you have to keep track of all that type of stuff. And you're going to be learning a lot about specific expenses very, very soon. Also, what happens during operating hours is certain liabilities will come about just from doing business. So, for example, what if your business bought something from another business and you owe them? So you might have your business might have a relationship with, say, Staples or Office Max for office supplies. But the deal is you can buy office supplies and they give you a bill. Well, that bill for you is something you have to pay. So an accounts payable is simply a bill you have to pay within 30 days. Okay. So you have to keep track of all those bills that need to be paid in 30 days, like these accounts payable. You might also need to pay your employees, right? Every time the employees put in their time cards for the week, guess what? You owe them that pay, the pay, whatever it is from next payday. So that's an account, that's a wages payable. Salaries and wages payable is a real liability that comes from just doing things. If you're selling things that are subject to a sales tax, you're selling stuff and you're collecting the sales tax. That sales tax is not yours. That sales tax belongs to the state. You have to remit it to the state. And so that sales tax that you collect needs to be put aside and sent to the state on a regular periodic basis. That's a sales taxes payable. So there are lots of little things that happen during activities, during operating activities. Another thing that's really important to know is at the end of a period, usually a month, definitely every month and up to a year, you're going to compare your revenues and your expenditures for that monthly period or that yearly period. When you have more revenue than expenses, you got a profit. Yay. In accounting, profits are called net income. And you'll see this on the income statement that we're going to be doing next um, learning objective. But sometimes expenses are bigger than the revenue for that period of time. This is what's been happening, right, since COVID, particularly in the restaurant industry and some others where, restaurants in New York or other places, they still got to pay their rent. They don't own the buildings for the most part. They're renting that space. They still got to pay the rent. They still got to pay the electric bill and other utilities. Those are just there. Those are expenses that are just there. But yet the customers have gone away. So in droves, and so you don't have enough revenue. So sometimes when your expenses are bigger than your revenue, you're going to lose money. That's a net loss. But both a net income and a net loss happens when you're comparing your revenues and expenses during that period of time. And again, as you'll see, the shortest period is usually month to month basis, and the longest period you measure is usually for the year. Okay. So now we're going to take a look at our little do it exercise for a wrap up of this part of the chapter. And I'm going to show you everything here. We'll do one at a time. So first we need to classify the item as an asset. Remember, the assets are resources that are owned by the business. Liabilities, which are, of course, those are anything that the business owes, usually a debt a business owes. Common stock represents the ownership shares in a company. Revenue represents the money collected when you sell something to a customer. And expenses are the costs involved in selling whatever you're selling, being in business. So here we have the first thing is the cost of rent. Now, most of you might not know that most businesses rent their facilities, whether it's an office or a retail store. Overwhelmingly, it's rented. It's rented. They have a lease. And how leases work is every month you got to pay rent. And so every month that you pay rent, that's an expense. That's an expense. Rent expense is a very specific expense that you'll see and learn about. but it is a cost of doing business in the store. A second thing here is purchasing a truck. Now, a truck is a resource that the company is going to be using. So, a truck is actually an asset, it's equipment, for example. Okay. We already talked a little bit about this earlier, but a note payable. A note is a loan. When you hear the word notes, that's a loan. Payable means I owe it. So that's a liability. Liabilities are debts. The fourth thing here is we issue ownership shares. So again, the word shares and stock mean the same thing. So this is common stock, common ownership, common stock. And any amount that you earn by providing a service or selling a product is revenue. Again, amount that has already been earned means you've already sold it to the customer. They've already given you money for that sale. That's revenue. Okay. So this is the first real overview that you have of some of the components of accounting that we're going to be looking at. And remember the real, and I've been teaching this for quite some time, the real critical point about accounting is the root word of accounting is account. So understanding those accounts is really going to help you understand accounting. Does that make some sense? That's my advice, to make sure you understand that. But definitely make sure you read and study. Questions?